Hello and welcome to Keeping Curious. In this video series, we explore some of today's big questions around financial crime and technology with the help of experts in the field. I'm Kathryn Peake, joining you live today from Linkurious headquarters in Paris. Linkurious, who's sponsoring the series, offers the next generation of financial crime detection and investigation solutions to teams of analysts and investigators at Global 2000 companies, government agencies, and nonprofit organizations. So let's jump in. Today's hot topic at Keeping Curious is cryptocurrency and risk. In the financial crime space, we know that anything new comes with a bigger dose of risk. It's just the nature of the game. Cryptocurrency is way less the Wild West than it was several years ago. It's become more mainstream. Regulators have established clearer guidance. But for many in the financial services industry, there remain a lot of questions and unknowns. So speaking of questions, we are taking audience questions during the interview. So if you have any, you can drop some in the chat. I know we've gotten some ahead of time, so we'll make sure to cover those in the discussion. So to help us talk about crypto and risk today, I'm thrilled to welcome Tara Annison. Tara is Head of Technical Crypto Advisory at Elliptic. She's an experienced speaker and thought leader in the crypto industry, writing and educating on a broad range of topics. She's the author of the Bitcoin ABC book and the creator of Cards Against Cryptocurrency. Welcome, Tara.
Thanks for having me.
So to get started, I wanted to ask kind of a broader question about the trends in cryptocurrency and financial crime risk. So, we all know stories about crypto wallets being hacked, fraud happening around cryptocurrency, and we also know that there are criminals who use it to launder illegal funds. So I wanted to ask you, from what you see, what is the major trend with cryptocurrency and financial crime? Is it more as a vehicle for money laundering, or do you see it more as a target for fraud?
So it's a really good question. And the answer, I suppose, is both. We do see money laundering happening in crypto. We certainly see a lot more fraud happening in crypto, though. And I think if we think of some of the numbers behind this, so we'll put this in context a little bit, because as you say, you do often see headlines that say crypto is only used for crime and X, Y, and Z. So when we think about how much is being laundered for NFTs, so they're non-fungible tokens, now since about 2017, there's been $8 million worth of NFTs that have been laundered through NFT-based platforms.
Okay.
This sounds pretty huge, doesn't it? 8 million. Well, actually, when you look at the context that, for instance, in January of this year, there was $17.2 billion worth of trading volume in just a month. Actually, the 8 billion is a pretty small percentage. And looking at trading activity generally, it's about 0.02%. So money laundering in NFTs isn't really a big proportion of the total activity. But that's just NFTs. When you look at, say, use of mixers, so these are services in crypto where you can pool your funds with other people and then take the money out again, effectively obscuring the flow of funds from sender and kind of the original sender and then the person taking it out again. There is a very well-known mixing service called Tornado Cash. They were recently sanctioned by OFAC, and around $1.5 billion was laundered through Tornado Cash by the Lazarus Group. So that's North Korea's hacking group.
Sure.
Now, that's, again, really big value. And the total value that went through Tornado Cash before they were sanctioned, but suddenly the volume's dropped off considerably now, so it's still around that figure, is about 7.6 billion. Some of that will also be illicit activity, but we can see in those two, certainly you've got 8 million that's being laundered through NFTs, 1.5 billion that's been laundered through Tornado Cash, specifically by the Lazarus Group. And then when we consider decentralized exchanges, cross-chain bridges, so these are all services that allow you to kind of move money around the cryptocurrency system at large. Around about 1.2 billion has gone through DEXs, which is linked to illicit activity like money laundering. So although you've got huge volumes going through cryptocurrency, which makes crime as a proportion still very low, the numbers are big. You do see a good amount of, or bad amount of money laundering, but a good high value of money laundering that's happening in crypto.
Sure. Okay.
When we think of fraud often catches the headlines a little bit more because it's your everyday person that's going to be impacted. You know, I am frequently spammed on my DMs in, say, Twitter, on Discord, on Telegram, with people basically trying to steal your funds. So there's all sorts of typologies that we see here, but there is, you know, pretty notable value that we see with people being the victim of fraud. So for instance, if you think about some of the main assets of NFTs, metaverse assets across DeFi, etc., there has been a pretty increasing trend. So in social media, for instance, and that's where you tend to see a lot of these frauds. We saw, I think it's about 23% rise in NFT thefts that were happening between the first and second quarter of 2022. So this year, the value of NFTs, so those non-fungible tokens, was about 15.4 million. So a lot of value that scammers are trying to extract by committing fraud in all sorts of ways that you can see across the space. And as Twitter seems to be one of the biggest areas there, but certainly as we see more kind of people using cryptocurrencies, more utility in crypto assets, we will just continue to see more scammers operating across the fraud angle of it, because it tends to be slightly easier for them to operate.
Sure. And I mean, we know that fraudsters are great at finding any opportunity to shake money out of their victims. I was reading an article today about an increase in elder fraud related to cryptocurrency. So yeah, two big trends kind of crossing ways there. So what would you say are the characteristics of cryptocurrency that make it vulnerable to fraud and financial crime?
A really, really good question. And it's, I suppose, important to look not necessarily the protocol, the technology, it's actually kind of everything around it. So a lot of people that are investing in crypto are looking to get rich quick. They're often millennials or Gen Z that are driven by this like hustle culture, the flip it culture. Many of them have low financial literacy, and that's not a slight towards them. That's, you know, the fact that in most kind of school systems around the world, we don't teach people about financial safety, even internet safety in many regards as well. So you have a lot of, in the crypto world, we often refer to them in a nice way, but they're referred to as plebs. So the everyday person investing in crypto, which means that they can be easily duped, certainly by sophisticated scammers who are targeting people brand new to the space and who just don't know when to spot the red flags. I think another factor which makes crypto kind of vulnerable to fraud and financial crime is just how easy it is to copy and paste across typologies from one part of the industry to another part of the industry. So what we often see is the scammers basically recycling the exact same techniques from a DeFi scam to an NFT scam, to a stablecoin scam, to an identity scam. They're just basically, as we say, copy and pasting across, which makes it really easy for them to say, oh, that scam worked over there with that thing. I will just do it again over here on this thing. And they find a new group of people who maybe weren't aware of the previous scam effort. So that's something that certainly makes them vulnerable. And then I think another challenge is just the kind of worldwide economic situation, which is generally pushing people to try more exotic assets. So if you use a traditional bank account, you're probably going to get a pretty low percentage return for, say, a savings account, or maybe you haven't got a good enough credit score to access traditional finance. And then you look at crypto as a way of getting around the traditional system to earn a higher interest or to get that loan, whatever it may be. But typically, you don't have the education from those platforms about some of the risks involved. And so that can mean that someone says, oh, fantastic, I'm going to get a 400% yield using this crypto service, and maybe it's a scam and they don't recognize the red flags, or they just don't realize that that probably isn't going to be 400% because the service is likely going to go bust next month because because they've got a really poor kind of token economic system. So yeah, I think those are probably some of the big characteristics that make it particularly vulnerable to certainly kind of the fraud and financial crime element.
Sure. Yeah, makes sense. So I wanted to talk about some money laundering topics specifically, because I know we have some folks there in the audience who are maybe AML officers or who are working with money laundering subjects. And it sounds like fraud generally is the bigger risk, but that there is money laundering happening with cryptocurrency. So I wanted to ask you about the blockchain. At what point is it a resource for money laundering investigations, or does it make them trickier? And if the blockchain does make investigations harder for those working in financial crime or anti-financial crime, is it because we don't have the resources or the knowledge? Yeah, I'd love you to talk about that a little bit.
So I think the beauty of the blockchain is that it's an open public record of every transaction that ever was. So that's kind of like more information than we've ever had before about the financial goings on of people. If you think of a bank, then it will understand and know about the transactions that its customers are doing, but it won't necessarily know about the transactions that someone who isn't a customer of theirs is doing, unless they maybe interact. Whereas on the blockchain, you can see everything that's happening. So there is this misconception still, sadly, that crypto is anonymous and therefore really hard to trace and track and utilize. But it's not at all. It's what we call pseudonymous, which is where instead of having Tara Annison represented on a blockchain and represented by a string of numbers and letters that we call an address. And you may look at that and think, okay, well, how do we ever figure who owns what address? It's a string of numbers and letters. Well, that's what we do here at Elliptic. We're basically putting entities to those addresses to say who is involved in a transaction. Now, why this is really important is that you can then take that open public record of every transaction that ever was. You can use software from providers like Elliptic to then say who is involved in that. Now, where that becomes really powerful is then you can do those investigations for money laundering or whatever purpose it is. And this is how we've been able to find things like Chinese spies using Wasabi Wallet to pay bribes to like an FBI double agent. We put that piece out, I think it was earlier this week. We and the FBI have tracked over $5 billion related to a very famous exchange hack that happened over multiple years. These funds are being tracked everywhere they went by many people across the globe. It's $5 billion on the move. Yeah. It's how we've identified addresses that have been used to receive terrorist donations from, say, Hamas or ISIS, for instance. It's how we've collected data for our myriad of different reports on NFTs, metaverse, DeFi, crime, etc. So all that information is kind of there for the taking. And once you use the power of a blockchain analytics software with all of that open data, then you've got some really powerful investigations you can do. Now, does that mean it's easy? No. You still need to be able to understand blockchain typologies. You need to be able to use those investigatory tools, and some on the market are incredibly complex. You kind of need a PhD in not just crypto, but how to use the system to work them. And so that's where it comes down to the education that's needed to make sure that you can understand crypto and specifically crypto compliance. You could take the most advanced, successful financial crime investigator in the world and say, here you go, here's loads of blockchain data. Tell us what you can find out. And they'll be like, I don't understand what most of these words mean, let alone how I use it. So that's where the kind of power of the data has to come together with the power of the knowledge to then be able to interpret that data. But it is a level of transparency that we've never had before. And that's why there's loads of really great examples. And I mentioned a couple then of the types of insights you can get once you know the types of thing to be looking for.
Okay, that's super interesting. So let's see, I have a few different questions for you. I'm trying to think of which direction it makes sense to go. But since we're talking about investigations, I guess I want to talk a little bit about risk and banking. The traditional banking industry has been a little wary of crypto, but I wanted to ask about, crypto's being used. It's a lot more widespread. There are a lot more people who have investments in crypto. A lot more people are making payments in crypto. It's definitely more mainstream than it used to be. So I was wondering if the more widespread use of cryptocurrency is changing the way that risk management is done at financial institutions, either ones who are working with business clients who are working with cryptocurrency, or how they're doing risk management with customers who may be transacting with cryptocurrency.
Yeah, so I think in this one, it's the change in how you're approaching risk management has to come down to the exposure that you've got to crypto. So if you are a financial institution and you're not touching crypto at all, then how you would manage your risk would be quite different, because you're going to have indirect exposure. So whilst you're not selling a crypto product to your customers, they're probably still buying crypto somewhere else. They might be buying some NFTs on various different marketplaces. And so you've got consumer protection risk there. Maybe you want to look at managing that indirect risk to you by doing more education, for instance, on the risks, so that they don't then fall foul and send some money to a scammer, for instance.
Yeah.
If you're selling products yourselves, then you need to be looking at the risk of banking or allowing funds to be sent directly to a terrorist, for instance, or someone on the OFAC sanctions list, or someone selling or buying products on the dark web using cryptocurrency and then using your bank account or whatever financial institution service you're providing to then move those funds through and onwards. And so I think that's as we see more and more people starting to use crypto, more financial institutions are recognizing that even if they don't have direct risk, there is going to be some level of indirect risk, and it isn't good enough to just say, I'm not touching crypto as a financial institution, therefore I don't have to do anything about it. On a minimum level, there should be some education that you're doing to users to help ensure that they don't fall foul to risks. And we know, for instance, if I think of my bank, when I send some funds, it will often pop up and say, just be sure you're not, falling foul of a scam. And that could be crypto, it could be traditional scamming. You mentioned before about the vulnerability of kind of age-based crime. And so making more sophisticated systems to try and ensure we can see when that kind of thing is happening, and also warn users so that you've got the protection at the kind of front gates as well as deeper down. I think we have to look at how we do that for crypto-based crime as well, considering that the vast majority of people who are going to fall foul of crypto crime and be a victim, they've probably also got a traditional finance bank account. They're probably funding their crypto payments from that. So if you can kind of help them at the source mitigate that risk, then it can protect them further down the line, as it were.
Sure. And we had a question from the audience that was submitted ahead of time, and I'd like to kind of bounce off of that topic to ask you this one. It's a little bit more specific. That person was asking for a financial institution who is not supplying crypto services themselves, what would you define as the number one threat related to customers trading in crypto? If you could name one thing.
Yeah, naming one thing I suppose is hard, but I think consumer protection. I mean, I'm trying to choose a big bucket here, but yeah, consumer protection essentially, because even if, as I said, even if you're not selling crypto products, your customers are probably still somehow dabbling in crypto, and they're probably using your service either directly or indirectly to fund that. So if you are a buy now, pay later service, maybe they're using the fact that they're delaying some payments with you to go and spend more money on crypto and take that risk out there, which then heightens your risk of potentially not being paid back if they then go and lose their money spending it on buying some kind of bad investments in NFTs, for instance. So I think consumer protection and certainly all around the educational angle there as well, making sure that you're doing everything you can to ensure your customers know how investments look from a safety perspective. It's the classics, isn't it? Don't invest more than you can lose. Make sure that you're aware of the red flags so you're not being scammed. But you can never say these things too much. And so I think as financial institutions at large, we can do a better job at trying to educate customers in our specific domain and more broadly to protect them against falling foul of any of those kind of crime risks.
Yeah. So we know that all financial institutions have a pretty hefty tech stack most of the time to protect them and their customers against fraud and money laundering. They're obligated to from a compliance point of view, but also from a financial point of view, it makes sense to protect themselves and their customers against fraud. So my question is that with the rise in cryptocurrency, how have you seen anti-financial crime technology adapting to risks linked to crypto?
Yeah, so I think that's one of the big challenges. Like, this industry moves a million miles an hour, so it can be really difficult to essentially kind of keep up with the bad guys. And I suppose what we see is the good thing in the kind of crypto industry at large is, as fast as the criminals are moving, the compliance risk management space is kind of working equally as fast to catch up with them. So we work with a whole bunch of different technology providers, whether it's on the custody side or whether it's on the travel rule side, to kind of enhance that offering there. So instead of doing that all in-house and having one company try and do it, you have all these like smaller companies basically specializing out, and I think that's incredibly powerful. Certainly for us at Elliptic, one of the biggest things that we've done recently, and is pretty pioneering for the industry actually, is something we call holistic. And that is really important, because in the olden days of blockchain analytics, and yes, the industry is only 14 years old, but we still talk about the olden days. You could do blockchain analytics by looking at a single asset and a single blockchain. So Bitcoin was the first blockchain back in 2009 when it was created. And then in 2015, you had Ethereum created. And between that gap, there was basically just Bitcoin. Like, there were some others, but it really was like very Bitcoin dominated. Now, when you look, there's over 21,000 cryptocurrencies, and certainly, within them, thousands of blockchains. And there's a lot of interoperability. You've got bridges that allow you to send funds from one blockchain to another. You've got services like exchanges and decentralized exchanges to trade. And so it's a really complex ecosystem. And criminals are using that complexity. They're trying to obscure the flow of funds by chain hopping or asset swapping. And so the olden days of just looking at a single asset on a single blockchain means that you're missing all of that risk. It's like saying, I'm going to look at this customer, but only the transactions that they do are in the UK in GBP. Well, maybe they're about to fly to Singapore and do loads of really dodgy stuff in Singaporean dollars, and you're like, no, not looking. And so what we do with Holistic now is take that view across all blockchains, all assets. You can try and swap them, you can chain hop. They're going to find you. We're looking across all the blockchains. And I think that's been a real big step forward for certainly us, but the industry at large, to keep up with the criminals as we can see them try and use obfuscation techniques. And yes, they'll always try and come up with something new. And so it's about trying to kind of stay ahead of it by these new technologies. One thing that we certainly do, and we have a really cool team that do this, they spend a lot of time on the dark web interacting with the bad actors. They obviously don't know it's us, but we're in there trying to find out the new techniques that they're doing. We're in there seeing what assets they're particularly favoring. And one thing I personally do is it's really good fun. Whenever someone tries to scam me, I pretend to fall for it, so that we've got this great opportunity for you to become really rich. Have you heard of crypto? And I'll be like, no, what's that? Tell me more. And then they reveal all of their techniques to me, and then I can write about it and warn others. So that's also really important, to make sure that we're kind of staying abreast of the new techniques. So then it comes down to the kind of the technological angle that we build with, say, Holistic, but also really importantly, that education, making sure that people are aware, so that if they've, say, read a post of mine and they say, oh, someone's just come to me with something, and I know Tara wrote that post about that particular technique, this feels the same thing, maybe this is a scam. And so I think that's really important, to stay kind of ahead of the criminals from a technological perspective, but also we have to just educate people and make them aware of the types of criminal actions and the typologies that people use.
Right, which is a lot of the work that you're doing. Your answer to that question is really interesting, because I mean, it's sort of a smaller version of what you see in the financial crime space, that things are getting more complex, transactions are getting more complex, things are happening faster. And I know in more traditional finance, the systems have tended to be really siloed, and that's becoming a big problem. So it's interesting to hear that in the microcosm of cryptocurrency, it's actually the same phenomenon as you see everywhere else.
Yeah, and that's why I think a lot of people maybe don't appreciate for very good reasons is there's so much of crypto that is what we call tradfi, traditional finance, but wearing a t-shirt rather than a suit. But it's the same thing. So a lot of the typologies are the same. A lot of the ways that criminals act are the same. So we can apply a lot of the really great risk management techniques that we see in the traditional finance world to crypto. And yes, there's some kind of quirky, interesting, slightly cool stuff that people do that you can only do in crypto because of the way it works. But there's phishing happens in crypto and TradFi. People doing wash trading happens in both. Money laundering happens in both. So we can take a lot of lessons from kind of both sides and apply it to the other. And that's why I think a lot of people come into the space and just get like flummoxed by it all going on. But if you've come from TradFi, yes, it looks and sounds a little bit different, but there is a lot of similarities as well.
Yeah. So I plan to keep this interview to about 25 minutes. We're getting towards the end, but I do say that there's a question from one of the attendees, and I wanted to make sure we had a little bit of time to cover that. So it's from Olivia, who's asking what risks you see associated with CBDCs, and if you could remind us what CBDCs are, would be great also.
Yeah, great question. Thanks, Olivia. So a CBDC, too many acronyms, is a central bank digital currency. Now, it's really important to delineate the difference between a CBDC and a cryptocurrency. So a large cryptocurrencies run on those open public blockchains where anyone can submit a transaction, anyone can be part of securing the network. A CBDC is largely not going to be based on a blockchain. There's very few examples where CBDCs have been built using any kind of blockchain technology. They're just typically digital representations of money. Think of it as like an upgrade to the traditional banking system, very much moving away though from fiat money that you can hold in your hands, so coins and dollars. But in so many ways, they will be very similar to the money we have on our cards, which is just magic internet money in so many ways, that it doesn't relate to a pile of, gold or dollars in a bank vault somewhere. Now, some of the risks associated with CBDCs, and there's certainly quite a few, from a monetary policy perspective. How are we going to figure out how to control things like inflation and the printing of it? If we're going to do quantitative easing, you lose a lot of the restrictions that you have in a world where you have to have physical real money when it's just an entry in a database. So trying to figure out how we manage monetary policy there in what is largely an uncharted territory is going to be a big thing. There's also big conversations on whether a CBDC is accessed by the everyday person or whether actually it's basically money that is moved between the kind of the higher levels, so the central bank and central institutions, which wouldn't really have as much impact, or certainly not a day-to-day impact on the everyday person.
Sure.
There's different implementations of that across the world that are happening. So it'll be interesting to see which one various jurisdictions choose. There's loads of other risks. I'll choose one more because we're almost at time. Privacy. So this is a big one when we consider the digital yuan that is being kind of rolled out already in China, and there's slim documentation on it, perhaps surprisingly, but one kind of phrase that has been spoken about is controlled privacy or permissioned privacy. Ergo, the Chinese government can see everything you do, but other citizens might not be able to see everything you do, but they can decide who sees what. Now, in a cash-based system, you have really strong privacy. Kathryn, if you and I want to do some kind of dodgy dealing in cash, we find a dark alleyway somewhere, we can do that. If we want to pay a journalist, or if we want to send some fundraising money to a woman in Iran, for instance, protesting, cash is an incredibly powerful resource from a freedom perspective, and outside of some of the controls that are in place, not necessary for everyone's benefit. If you have a digital money, which can be effectively turned on or off, and everyone's actions can be seen by the government, those things might not be possible anymore. And so there is big questions about how do we balance privacy and the right to financial privacy, which is a right for all. Privacy does not mean you're doing something dodgy. It is completely normal. and something everyone should have. How do we balance that with the need to manage financial risks associated? So there's some really big questions that are being discussed at the moment. But yeah, it's really important to kind of delineate between the CBDC work, which is very kind of government level policy driven, versus cryptocurrencies, which are much more libertarian, certainly in their creation, still heavily regulated, but a very different ethos.
Sure. All right, I think we're going to leave it there. I had some other questions for you, but I wanted to keep it short. So thank you so much. I learned a ton, and I hope the audience enjoyed it also. It's been really great chatting with you.
Thanks. Great to talk to you too.
Have a nice day. Take care.
Bye.
Thanks, everyone.